From the morning reading, spiders, diamonds, IWM, pause at resistance, form horizontal breakout setup. 8 of 9 sectors moved lower on Thursday. XLU, XLI, and XLB were the strongest sectors, while XLE was the weakest sector. Oil futures rolled to a new month and fell 0.92 to close at 32.73. Breadth was mixed as advancers led decliners 1.04 to 1 on the New York Stock Exchange and decliners led 2.56 to 1 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:01 a.m. Central Time, and I'm recording this in preparation for the market day of February the 19th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. A relatively quiet night compared to so much of what we've seen in the past several days. It is a little weak, and S&P futures were down at the time of this cut about 9 points, or about 0.5%. The Russell futures were down about an equal percent. NASDAQ futures also 0.5%, as are the Dow futures. Crude oil down pretty big, down 2.16%. Euro up just marginally. Bonds up about 0.5%. Gold up about 0.6%. In overseas action, you have China down just below scratch. Hong Kong down about 0.4%, Japan down about 1.4%, Germany down over 1%, and United Kingdom down about 0.2%. In terms of macroeconomic reports today in the United States, we just have the core CPI, and that's out before the market opens, so nothing after the cash open. In terms of current volatility conditions, yesterday was pretty much a relatively benign day. The short-term VIX is now below a 20, skewed just barely above the cautionary threshold of 125. So the probabilities of a 2 standard deviation move in the next 30 days are a little bit elevated. IV percentile continues to fall. We see the S&P now down to a 36. The Russell 45, NASDAQ 45, and Dow 37. No standard deviation moves were put in yesterday on a close-to-close basis, though that was after 3 straight days. In fact, we had 3 white soldiers on the candle pattern, a relatively uncommon pattern where we had standard deviation moves put in 3 days in a row and 3 big white candles coming into play. In terms of the charts, let's go ahead and go there. And you see our recent action on the futures, and you see these 3 big bullish candles. Those, look at that. I mean, we even had a gap in between this one, just barely overlapping the open on this one. And basically the open of the day near the bottom, the close of the day near the top in all 3 cases. And that then ran into, in yesterday, a little bit of a pullback. On the S&P, I wouldn't make too much of this candle. Perhaps you call it a spinning top, a little bit of indecision, a little bit of further retracement so far today, though not so much so that it couldn't reverse and totally become a green candle by the end of the day. We're down a little bit, but not enough to make a big statement about it one way or the other. So where are we? We're up against resistance, and we've been playing right up against this resistance area from the former swing high. So right now we have a double bottom and or similar bottoms and a similar tops. So we are in a sideways pattern. So this is not higher highs, higher lows. This is similar highs and lows. So we're in a sideways pattern, basically in a box, rectangle, until proven otherwise. We need to break out of that box. Now, this resistance area is just that. It's an area. You have some similar highs right now here, but you also have this little bit, just teeny bit higher high right here that preceded this one. So I would paint this area as a resistance zone, and until you get a close above the 1945 using the futures chart, you really are still in the resistance zone. So don't get suckered in thinking that you have a breakout and you're still in that resistance zone. So let's look at some of the others, and we've got some pretty interesting patterns on some of the others. Here is the Russell, and see right now we have not yet made this former swing area. So right now we have a lower high, we have a lower low, a lower high. This is a right now a trend continuation pattern. Both short term and intermediate term are still bearish on the Russell. So until we get a true higher high, we have to expect that this is a trend continuation pattern to the downside, and you should trade bearish on the Russell until proven otherwise. In terms of the NASDAQ, we also at this point have a lower low and a lower high. So as the same thing as the Russell, the NASDAQ is in a short-term and intermediate term bearish trend until proven otherwise, even despite these big moves. Just the fact that it did this in 3 days, yes, that was short-term confirmed reversal, but right now this is a reversal pattern back to the short side. So this also probably didn't quite hit the definition of dark cloud cover on this pattern. Certainly it could be called a bearish harami, and that itself is a reversal pattern, and if we get confirmation today, that certainly would be indicative there. Still doesn't have to confirm today. This is just a start of the day, so don't get too far ahead of this. On the Dow, unlike the others, and remember the Dow is the most defensive, and it held up the best. It didn't have a similar low. Not quite. I mean, you could, I guess, call this a similar low, but bottom line is that this swing low was a little higher than this swing low, and so this could be called a higher high, and then right now, or a higher low, I should say, and then right now we have a higher high that's in place on the Dow. So the Dow's in a very different kind of intermediate term posture than are the NASDAQ and the Russell, which are clearly still in short term and intermediate term bearish postures. And then you had with the S&P, as I said, also in the stack order of things, relatively a defensive index when you're in bear market trends compared to the NASDAQ and the Russell, and it was in that sideways pattern. So differentiate between the four indices and then take from that what they're telling you. Big picture, we generally default to the S&P to give us our signals, and the S&P is in a sideways pattern, but you have two indices, the kind of growth-oriented indices that are still bearish, and you have the most defensive one that is in a kind of barely intermediate term bullish posture, or trend reversal kind of posture. When we look at where's that money going, well, certainly we've been looking at bonds, and you see bonds have also, while we had that reversal pattern, it has now had a big reversal pattern going the other direction. So right now, this is a bull flag pattern in bonds, and you had, with yesterday's action, an entry signal with going long in bonds. Well, going long in bonds is usually saying go short in equity. So kind of an interesting confirmation there coming from the bonds. And volatility, you also had, you know, the retracement, and then you had this pattern here, which right now is setting up as also a reversal pattern, confirming what's happening in the bonds. Again, relatively small action here. It's just the start of things. We need confirmation, and all we have right now is a confirmation at you know, an hour and a half before the open, and certainly we don't even have all the market participants in play yet. But this is what the early signals, the early tea leaves are telling us, so kind of be aware of that. That all this is happening at the same time that the S&P and the other indices were coming into these swing resistance areas. Not a bit surprising. We'll have to see just how far if this indeed does pull down, how far this pullback goes. Do we go back to the bottom of the range? Do we set a new lower low? Do we break down? Or is this just going to be to where we pull back off resistance into a little bit of a bull flag pattern in the very short term and then go through that area of resistance on the next time through? You can see with the cloud and so forth here, there's a lot of resistance stacked up here, all kinds of moving average lines, the 50-day moving average, the cloud, all these kinds of resistance areas. So it's going to be a big fight to be able to get through that area. And as we look at our daily report, we'll see why this is so in some ways. We have had in that intermediate term phase opinion, we are in phase 2. We've had some improvement there, trend reversal, foot in the water. You know, you should be selling puts a little bit more aggressively than you were in phase 1. You should be putting on some stock positions, ideally defensive ones, such as utility positions or consumer staples. But you also have some improving signs. The portfolio investor posture, IBD status, has gone to confirmed uptrend. We do keep putting that caveat around that. We've had 13, 14 confirmed uptrends since this sideways market began in November of 2014, and not a one of these confirmed uptrends have really led to anything. Accumulation distribution score, S&P is a pretty lousy D-, NASDAQ also an E, so breadth, very, very, very poor. GMI index, a pretty woeful 1 out of 6. It's been a consistent sell signal since 1210. That author retains a 100% in cash status. We've had some changes on the decision point scoreboard, and you notice that we've got a whole bunch of short-term up signals now. Now keep this in context. And I read, let's see here. I had a little bit of a snippet from a blog article behind the person that is responsible for the decision point scoreboards, and they made a big deal about the fact that when you get a short-term signal in a bearish trend, that you know, you treat that differently than you do when you get a short-term signal with a bullish long-term trend. That is, you know, an early signal, an aggressive signal to jump in on a pullback and get onto that bullish bandwagon. In a bearish trend, this is often seen more as a bear flag. It is a dead cat bounce, those kinds of patterns, and not one that you're going to be wanting to load up based on. Now, obviously, at some point, that bearish trend does have an ultimate reversal, and that short term does then bleed over into a bullish intermediate term, into a long-term bullish pattern. But for every time you get that one right, you'll be wrong multiple times in a true bearish trend. So right now, we're thinking that this market is ultimately, at best, neutral, and that got to be pretty defensive in jumping on these short-term bullish signals. In terms of position sizing opinion, you do have the 100% position sizing mechanical opinion on the portfolio investor, and then the 50 to 75% opinion from the volatility-based VIX futures signal. So kind of keep those in mind. So certainly the signals are a little bit more aggressive position sizing, and yet at the same time keep it in context with the overall picture of all the signals that you're getting. The intermediate term market posture has improved. We are in weak bull, but we have that very bearish sentiment line. So very, very really overall neutral kind of pattern, and that very much matches up with what we're seeing in the S&P charts. The S&P is weak bull, as is the Dow and the NASDAQ. Even the Russell now has pulled up into a weak bull. So we do have alignment here coming off of these 3 strong days. Has helped pull these numbers up, and we now have this intermediate term market posture. This gives us permission to take bullish trades. At the same time, we want to maintain that defensiveness. Indeed, the strength of the bullish trend is very, very weak. We're well below the 80 that we use for a strong bullish trend and bullish markets. Hedge warning status remains a level 1+. So some elevated risk conditions are present. It's not a prediction that we're going down, nor how far. It's a recognition that there are some elevated risk conditions. We're kind of in a cautionary stance. That very much matches the rest of our signals. In terms of specific signals, you can see a lot of these that used to be red just a few days ago have ebbed off. We still have a couple of them. VIX futures are still up over 18. That's in a bearish zone. We have also the expected move a week out on the SPX is still up over 40, though not remarkably so. You did have a very good day on the New York Stock Exchange yesterday with over 300 on the new highs, and we still have all 5 of the key intermarket risk aversion indicators now flagging as risk on. Short-term sentiment for stocks is an 8, so that's a warning there. We've run a long way up in a very short time, and it's getting kind of risky to be taking new bullish trades right here in the face of the resistance. Probably best to wait to see for a breakout if you're not already in a position. In terms of fear and greed, this continues to improve. You see we're now up to neutral, so very much with the rest of the signals that we're getting, a lot of neutral numbers. In terms of special opinions, you have the VIX still outside the acceptable window to initiate new positions for novice traders. More aggressive traders can take advantage of the additional premium, but knowing that a larger than normal delta and Vega moves are absolutely in the order of things when you have this kind of VIX setting. We've been still continuing with our option income strategies, but we've been reducing the position sizing pretty dramatically. So, even 10% of a full size on some of the strategies. So just kind of keep that in mind. Cover call strategies, put selling borderline acceptable. Be in context that you are right up against that resistance area. So if you're not already in positions, you might want to wait for a breakout. If you do enter positions, there's a number of defensive strategies here. No changes from yesterday on this, but just kind of keep that in continuous top of mind. In terms of sector specific, you can see it's pretty much gone to a sea of green on the short to intermediate term. Some neutrals here. Look what the neutrals are. Financials, healthcare, consumer discretionary. Those are some of those higher beta areas oftentimes, especially financials. And now healthcare is kind of mixed, and what's you got to keep in mind on healthcare, it's been beaten down, but it's the biotechs that are beating it down. Other parts of healthcare are, as you can see here, much lower beta, but this is being drugged down by really poor performance in IBB, the biotech kind of industry group of this sector. In terms of percent change, you see the utilities big day yesterday. It was like 2 standard deviation move on the utilities. Telecom also, again, defensive, whereas the riskier areas all kind of down here in the bottom. So just kind of keep that in mind. These areas had seen some improvement with the recent bullish short-term action, but they were going to be the first ones to give it up in the first signs of weakness. You got to stay on top of that. So I think that's enough for that today, and let's see what we might want to spend just a moment speaking about. Well, let's talk a little bit about YouTube. Obviously, if you get some value out of what you're getting here each morning with the market preview from Falcon Global, the way you can say I appreciate that is by liking us on YouTube, by tweeting us to your Twitter followers, to your StockTwit followers, and you can also subscribe to us on the YouTube channel. When you do that, you'll receive notice that content has been published, so that allows you to jump on it first thing in the morning as soon as I finish and get this posted. I would suggest once you get that notice, you wait a couple minutes, and if you do that, you'll be able to see it in high def. And indeed, note on the YouTube page, there's a little gear, a little settings button. Get that button. Make sure that you're watching it in high def. You'll see this in the greatest clarity, and that's particularly important when you're looking at the charts and all. The other thing is you can resize it, and kind of blow the screen up. And then the last thing I would suggest is that you can play with the playback speed. There's a little button there that allows you to speed it up, and you'll probably find that you can follow much of this at 1.5 and cut the 20-minute presentation down to about 13 minutes. So that's always helpful as you're managing your own time in the morning, where you want the information but you want to get it distilled as quickly as possible. So that's enough for today. I will just scroll through the rest of these. If you see something you like, just hit the pause button, go to the hyperlinks, and you can get additional information, such as our upcoming cover call class that'll start in the middle of July. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and note that the bottom of this slide you do have the hyperlink that takes you to the full set of disclosures. We'll see you back here Monday morning for the Falcon Global Market Preview. Good trading.